It is the last week of the election campaign. You might have already voted. More than 10% of people, in fact, getting on close to 12% of people have now voted. They've pre-polled. And yet, of course, if you did pre-poll, you might have missed out both the government and then Labor jumping in immediately to provide this support for first home buyers. Now, trying to understand that scheme, well, at face value, it seems all fantastic. But then you start to sit and work out, well, hang on, who actually gets this support? Because there are, as we've identified tonight, some 112,000 first home buyers on an annual basis. And don't believe some numbers you might see out there saying, oh, the proportion of first home buyers is going through the roof at the moment. It is in percentage terms, but in number terms, it's going backwards, right? Because the number of new home loans being issued has dropped through the floor in Australia. Those numbers came out today. But in this particular case, 112,000 first home buyers, but only 10,000 of these new supported loans would be backed by the federal government under the Prime Minister's plan, which has now been backed by Bill Shorten. So what I did, we got the Social Security Minister, Paul Fletcher, and had a chat to him a little earlier. Here's how he tried to explain it to us.
The support will be targeted to entry-level properties, and the maximum loan size will be determined based upon the relevant region, and just reflecting the fact that property markets are different in different parts of Australia.
Okay, I get that, but I still don't get the point that you've got 112,000 first home buyers and only 10,000 are going to qualify. And that, to me, doesn't actually spell fairness. Where is the equity? Where is the fairness in this? Where is the I miss out, so why is that fair that somebody else gets it?
Well, what we want to do is work through and target this particularly to low and middle income purchasers. So we'll be doing that through targeting what the entry-level properties are that will be eligible.
Okay, there's a few problems here, though, aren't there, really? Depending on where you are, if you're in a major capital city, Melbourne, Sydney, Brisbane to a certain extent, the property is more expensive. Now, remember, they put a cap in income limits here, 125 grand for singles, 200,000 for couples, and with the proviso that each member of that couple, that they are each of them first home buyers. Now, the point is that clearly they are saying, well, we're going to target it. So they're going to give out more potentially to those people in more expensive areas, and they're going to give out less, but perhaps more loans in areas that are sort of more affordable. Think about country regions. Think about some of the smaller cities. Adelaide, for example, might be one example. Okay, but I still get back to the problem, and that is there's more than 110,000 first home buyers on an annual basis, but they're only giving 10,000. So it just doesn't seem to me to add up. And the reason partly for that is also then, well, how does it work? Well, they're going to use effectively the national scheme that they've got that is going to basically provide the support. So they'll go out there and they're going to actually go to their own body that they've created. This particular body then in turn will lend the money to the banks that they will then lend in turn to the borrower. That's how it works. There's $500 million an issue. Now, I'm still sitting here and struggling that the National Housing Finance Investment Corporation, it'll guarantee the loans, so the smaller lenders will get it. But what, is it like a chook raffle? Do you just put your... Okay, Jordan Wakeford, you got the home loan. Tara Moroney, you didn't get the home loan. Sorry, you missed out. So how do you do it? Two of the people work on the program here, both of them prospective first home buyers who get this scheme. So then you sit there and you say to yourself, all right, you've done this. Are you arguably, in some cases, giving debt to people with a loan-to-valuation ratio of 95% while house prices are falling right now that they should not get anyway? Have the banks been right in raising the loan-to-valuations required to get a property loan right now simply because of the risk involved to the individual who may not need or want the loan in future years? Somebody who studies this is Martin North from Digital Finance Analytics, who has identified previously on this program the number of Australians already prospectively in negative equity. In other words, would effectively have to find the money or go broke if they had to sell their home tomorrow. And that could occur as a result of divorce, a business going bust, or them losing their job. And he's on the line right now. Martin, many thanks for your time.
Hello there.
Okay, so the government now subsidising home loans effectively, even that's denied by the Prime Minister, by underwriting the loans that would go out to these first home buyers. Good policy or not?
It's a thought bubble, Ross. I'm afraid that I am very sceptical of this whole thing, right? You rightly called out the small number. Property prices are falling, and, you've got a 5% equity you put in, and then property prices drop 10%, and you've lost that, and you're in negative equity. It doesn't make a whole lot of sense to my mind. The other point, of course, is that where you have first-time buyer incentives, what happens is it tends to lift the price of all the properties in that sector of the market. All of the incentives, both state and federal ones, have always done that. So it could actually create that sort of problem. The other point I'd make is that if you're a first-time buyer and you were thinking of buying in the market, you might now not until January next year. So, in fact, they might actually take people out of the market.
The reason is if there's 10,000, they say, sorry, you're 10,001. We've already filled up our allocation for this year. You might go, well, I could wait for 12 months and put myself back into the ballot next year, or I could scrimp and save and try and see if I can get a bigger deposit. Most people, I'd suggest, would say, oh, the hell with it. Let's go back to the avocado on toast and we'll go and take an overseas trip and we'll just jump into the ballot next year.
Well, I think that's right. The other point I'd make, though, is that my research says that those who have not saved up, for example, if you get money from the bank of mum and dad, are 3 times more likely to default in the subsequent 5 years because they haven't had the discipline of saving for that deposit in the first place.
Wow.
So all of these factors suggest to me that this is more a sort of a political signal than it is a fully thought-out policy. In the scheme of things, the probability is that home prices will continue to fall over the next 12, 18 months, 2 years. That means that almost everybody who buys into the market now are going to lose money if they do so, which suggests that perhaps they should wait and buy cheaper later. There doesn't seem to be a lot of science behind this. And actually, here's another thought. What about the lenders' mortgage insurers who actually have been filling the gap, as it were, between the 80 or 70% and the 100% on behalf of the lenders? Some of their business has just disappeared if this comes in. So
disappeared out the door. 100%, Martin. And one of the interesting parts about this, and I'll be honest here and say this, because we try to get the chief executives of those mortgage lenders, insurers on the program, because I've often described them as the canary in the coal mine. They're the ones who, they know what the risks are. They know where the exposure is. They're the ones who should be speaking out about risks in the housing market like you do, Martin, because you're the one who comes out and says, look, we think there's a lot of people who'd be underwater if they had to sell tomorrow. That should be really the job of the mortgage insurers, to not only be warning the community in the public, but also warning the lenders that maybe some of their standards have got a bit out of whack. Now, the problem as I see it, Martin, is that those mortgage lending insurers, so we've got Genworth and we've got QBE in Australia, they're the two, the big ones, they don't speak. They refuse to speak publicly. And in fact, they're frightened to speak, it would seem. Genworth in particular, we roll up to them the whole time and yeah, we're going to do it. And then all of a sudden they fall over and fold. Same thing with QBE. So to a certain extent, they're almost become their own worst enemies by not being forthright spokespeople for the community and for their own industries to try and make certain that lending standards are absolutely right. So, you're right, they'll lose the business. But let's get back to this, because the problem as I see it is, does this potentially create the scenario where people end up with debt that they should not have, and therefore does that not make potentially the housing market even more dangerous, that a bubble type scenario, which is right now deflating, could be deflating even faster in the future?
Well, I think it's definitely possible. So part of the question is, if let's take the scenario where you've got the 80% loan from the bank, you've got 15% from the government, and then the 5% deposit. Right now, will the bank make an assessment of that loan based on 80% or 95%? Right? If they're making it on 80%, what happens about that 15%? Does that still have to be paid to the insurer?
They can't do that, surely, Martin. They can't, because the person's still borrowing 95%. It doesn't matter whether the money's being funded by the government or whether the money's being funded by the bank. So they've got to assess them on their ability to repay the 95%, because that's the risk that they're taking. They're taking on a bigger loan, aren't they? Their repayments are larger. All that sort of stuff just becomes part and parcel of what they're doing.
Yeah, well, so my view is they'd have to assess it on the 95%. So effectively, you are already assuming that there's going to be bigger repayments than at 80%. So that's the first point. So that's going to be hard.
I've got a dumb one to recognise with you. Let's say, for example, that we've got this organisation, the government body, and let's say that the lender goes broke. They sell the house, there's negative equity. Who actually gets paid out first? Does actually the bank get paid out first, or does the government get paid out first? It's not a bad thing to think about either.
No, well, that is exactly right. And so overseas, where this has been done, effectively the government has a prima facie dip before the bank. So that may well mean that the bank will have to hold higher levels of capital for these types of loans, which means they may well have to charge a high interest rate as well.
Gee.
The more you look at this, the more you realise that it really has not been thought through.
It's a can of worms. And the final part about this is, though, Martin, and there's no surprise here, that both the building industry and also the housing industry are very much behind this in a big, big way. They think this is a great policy, and you kind of understand it because from a vested interest point of view, it means potentially there could be a little bit of a floor to the housing price fall if they can actually attract more of those first-home buyers into the marketplace.
Well, there's been lots of people from the construction sector and from the developers and from the real estate sector all claiming that we've hit the bottom and it's now going up, etc. This is just another example, I think, of vested interests steering not good policy but frankly bad policy.
I'll tell you what, it's going to be interesting to watch it. Martin North is with Digital Finance Analytics that measures really the stress inside our housing market, and he's been watching it for quite some time. And quite clearly now you can see that this policy that's been announced on the eve of the last week of this election campaign, well, whether it's been thought through or not fully, if it has been fully thought through, it has not necessarily been fully explained to the Australian public. And Martin North, I appreciate your time on the program this evening.
Good to talk to you.
We will take your